All right, we're continuing our reaction video series here on the channel with a new one from BiggerPockets going into the BRRRR strategy. If you've never heard of the BRRRR strategy, it's also known as value add. It's one of my favorite real estate investing strategies. It's actually the first way I did my first deal. It was the first strategy I used. It stands for buy, rehab, rent, refinance, and repeat. So basically what you do is you buy a property that is probably vacant, maybe needs a lot of work. You get in there, you repair it, you rent it out, and then you refinance the project, right? So now that you've repaired the building and you've rented it out, it's gonna be worth a lot more, right? You're gonna have trapped equity in the project that you should be able to pull out through a refinance. So once you pull all of that capital back out after you've stabilized the property, you go on and repeat it. I use this strategy for commercial properties. The first building I ever used it on was an office building, about 12,000 square feet. Brandon and the folks over at BiggerPockets typically focus on residential. So let's dive into how they look at the BRRRR, and I'll give you some tips on how I look at the BRRRR from a commercial perspective.
Okay, so somebody asked me to explain the math on a BRRRR deal. Now remember, BRRRR is buy, rehab, rent, refinance, repeat. We buy a property, fix it up. We buy it with short-term money, fix it up, rent it out, go to a bank, get a refinance, and do it again.
Cool, so we're gonna be diving into the numbers and showing you how the math behind the BRRRR method works. And Brandon just said that you could use short-term money as well for this. So traditionally in commercial real estate, you're probably going for a more conventional type of loan. One other loan type that you could actually use as a real estate investor could be hard money. You could use a short-term loan. Typically, it's going to cost you a little bit more on an interest rate. You're probably going to have to pay a few more points on the front end and maybe even a point on the back end when you refinance, but they are much less stringent on your financials and the project and stuff like that than a traditional bank would be. So if you only need money for maybe 6 to 12 months, you're going through a renovation and flip or something like that, or a BRRRR, that could be a really good route for you to take.
Let me explain how that looks mathematically. Let's say we find a property, and we are able to buy it for, we're gonna do real simple math here, like 200K. So
man, 200K for a piece of commercial real estate would be pretty amazing.
We're gonna buy it for $200,000, the B. Then we're going to need, let's call it $40,000 to fix it up. So 40K to fix it up, which means that.
So he's done a $200,000 purchase price, a $40,000 renovation price. So basically what he's doing is just using round numbers to say, hey, we're gonna take 20% of the total purchase price, and that's gonna be our rehab budget. Now, obviously on every project, it's going to be different. There's no just percentage number that you can throw onto a deal and say, hey, this is what my rehab budget is. Every project's different. Maybe your property needs a new roof. Maybe you've got a restaurant coming in and you've got to add in an HVAC unit. Every single thing is going to be different, but obviously we're going with very round numbers.
Total we're going to need is $240,000. Let's go 250 just to cover, closing costs and whatever else. So we're at roughly $250,000. Now we use what's called short term, don't mind my bad handwriting, money. Usually hard money, but it could be borrowing from like an IRA or 401k or cash you saved up or a line of credit, a home equity line of credit, whatever.
So what he's probably about to get into with this method is that if you have the cash on hand, you can actually pay cash for a property like this, get it fixed up, get it stabilized, get it rented, and then refinance and pull all of that cash back out. And when I say all, it could be all, most, maybe you'll be able to even do a cash out refi, which means that you will be able to get even more than you put into the project pulled out, hopefully, right? And then still cash flow the property after you're done.
So you use short-term money to buy it. Now with the 250 and fix it up. Now you go and you rehab with that money, right? So you buy it for the 200, you rehab it. Now you're all in for 250. Now you rent it out. And let's say this property rents for, I don't know, we'll call it $2,500 every month. So we can call this like a multifamily, right? We're now getting $2,500 every single month.
So that $2,500 a month number, if you're not familiar, he's basically using the 1% per month number that a lot of the BiggerPockets, a lot of the residential guys like to use. Whatever your total cost is in the property, you should be getting 1% of that back in rent every month. So he had $200,000 for the purchase price, $40,000 for rehab, and then you had 10% for closing costs, so a total of $250,000. 1% of that is $2,500 per month. Now again, that's not a perfect number, but it does help you understand whether a project could work or not. Kind of one of those back of napkin numbers that we like to talk about.
Rent for this property. But now, we don't want to keep this short-term money. We're probably paying like 10% interest on it, maybe 12% on hard money, right? We don't want to keep that for long. So now we go refinance. We get a new loan. Now, a bank will likely give us 70 to 80% of whatever it's worth.
So 70 to 80% of the value of the property. So that's 70 to 80% loan to value LTV. That is typically how a bank's going to look at it. You could see the same thing for commercial real estate. Typically in commercial real estate, the banks are going to want to have less exposure. So they're probably going to be closer to that 70 to 75% LTV range. But again, it all comes down to the loan terms that you want to negotiate. Maybe you want to have more money left in the deal and get a lower interest rate, or maybe you leave a little bit more money in the deal, but you get a 25-year amortization instead of 20, which is typical in commercial real estate. That could help with the cash flow. The bank feels secure because you have more equity in the deal. There's so many different numbers and levers that can be pulled when you're negotiating with a bank.
Well, let's just say the property now at the end is worth $350,000. We fixed it up. It's now worth $350,000. Let's say we found a bank that was willing to do 80% of $350,000. They would give us $280,000, which, if you notice, is actually enough to pay off the entire $250,000 we borrowed for the short-term money. In fact, we even left with money. And you have 75% or even 70%, different lenders, different amounts. But the point is the math I'm trying to explain here. And now we have all.
So he just did exactly kind of what I was saying, is you may be able to pull some cash back out of that project. Some banks may not want you to do that necessarily. It comes down to your relationship with them. But yeah, I mean, look, if you rehab the property, get it reappraised, and it comes back for $350,000 in this case, and you're able to pull out $280,000, you just got paid $30,000 to buy yourself a property and to make monthly passive income. It doesn't really get much better than that.
We have all of that money back to the hard money lender or whatever we borrowed it from, our savings or whatever. It's back. We have no money in the deal anymore. We're looking at probably a 4% mortgage, really low mortgage, maybe even lower.
It's funny. I can tell that this video is a little bit older, probably a year or two old, because he just said a 4% mortgage on residential, which right now it's like below 3%, and it has been for a while because of COVID, of all things, which is crazy.
A 30-year payoff plan, which keeps your payment tiny. Now you got a nice property that you have totally fixed up, so you have hardly any repairs and maintenance. Nothing's breaking on it because it's already nice. You attracted really nice tenants because it's already a fixed up property. Nice tenants are attracted to nice properties. You have a 30-year mortgage ahead of you. You don't have to worry about the mortgage going away. You're getting top dollar for rent. Rents are only typically going up long term. Over time, your property value gets paid down. Win, 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 win. You got no money into it at the end of the day, and you move on to repeat the process.
Repeat. Yeah, it is a win, 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 win. I mean, look, if you're getting paid to basically renovate your own property, you're getting paid to buy that property, you're getting paid to rent that out and make passive monthly income. I mean, that's what commercial real estate investing is all about. That's what real estate investing is all about. It's just finding deals like that. Because again, in this scenario, you start off with, I mean, let's say you paid cash. You start off with $250,000. At the end of the day, you're walking away with $280,000, and hopefully this is probably only 4 to 6 months later, $280,000 with a property and a tenant in place. I mean, you can just see how that can keep snowballing. You keep putting that money back to work and back to work, and eventually now you've got $500,000. You can do two properties at the same time. So it really helps you start to snowball your portfolio as you want to grow as a commercial real estate investor.
You repeat the process, the final R. So you buy, you rehab, you rent, you refinance, and you repeat. Now, is that the only way to invest in real estate? Of course not. There's lots of strategies, but this is how I built most of my portfolio early on in my business. And the thing that
it's one of the best ways to build a portfolio by yourself. If you don't want to raise capital from investors, doing the BRRRR method is very good. Now, obviously, in commercial real estate, the prices are way bigger. I'll tell you in a minute about a project that I did, the first commercial project that I used the BRRRR strategy on. And that was 5 times the cost of this. So obviously when I was 26, I didn't have or 27, I didn't have the capital to just pay for a $1 million office building and a $230,000 renovation. So I did syndicate that and raise capital for it, but I mean, maybe you're a doctor and you've got $1 million in cash sitting around and you just want to go to put that to work. I mean, here's a possibility for you.
That I continue to do today. BRRRR works whether you're doing single family houses or multi-million dollar properties and everything in between. Now, are there downsides? Yes, this video is not meant to tell you every one of them. I would highly recommend.
Let's talk about a couple of the downsides of the BRRRR. One thing that people don't think about is that the cash flow in the back end is actually going to be a lot lower than you expect, because again, you're taking a property that may not have had any debt on it and you're putting all of this new debt on it, which means that your monthly mortgage payment is going to go up. So while you may have good equity in the property and you may have made money on the renovations, your monthly cash flow is not going to be as high as a lot of people think that it might be. I mean, honestly, with some of these residential properties, you're cash flowing 100 or 200 bucks a month. Now, again, you might be able to pull out 30 grand in profit after you refinance and go do it again. But I mean, I couldn't get excited about $100 to $200 a month for all of that work and all of that risk. Commercial is a bit different though. We're talking about several thousand to tens of thousands of dollars a month.
I would highly recommend checking out David Green's book. David Green, my buddy on the podcast, my co-host, he wrote a book called Buy, Rehab, Rent, Refinance, Repeat. It's all about the BRRRR strategy. So
sounds like they've got the Bible on it. Go buy that book.
Make sure you don't just go jump in based on this video. Buy the book, check it out. If you enjoyed this video, make sure you give that little thumbs up below the video. Let the world know it's good. And subscribe to our channel everywhere at BiggerPockets.
So I'll tell you about the first office building that I ever used the BRRRR strategy on. Again, it's kind of just a value add, right? So it's not as common in commercial real estate, which is interesting to me because it is a very good strategy. Now, the building was $980,000. I actually found it on the market. This was June of 2019. Check out this video here where I dive a little bit further into it if you're interested. But basically bought it for $980,000, and we needed to reposition the property to go from 6 tenants to 17 tenants. I wanted to turn it into kind of a micro office space. So we spent about $230,000 on the renovations there, and I like to call this my failed BRRRR. Failed. Because the project ended up being so successful. I actually syndicated that deal. I raised capital from investors, and I sold them on a 36-month timeline before we'd be able to even stabilize the property, refinance, and give them some cash back. And because of the smaller unit size and the pandemic hitting, people wanted to rent that space and get out of their homes. So we ended up fully leasing it out within about 14 months. And I had a client from our brokerage that actually needed a 1031 exchange, and they offered us $1,650,000 for the property. So think about that. We're in it for we bought the property for $980,000. We paid $230,000 for renovations. So let's call it all in at $1,200,000. And within 16 months, we got $1,650,000 payout on that property. Even if we had just said, okay, let's appraise it for $1,650,000 and do the traditional BRRRR strategy. I mean, obviously we couldn't just appraise and say this is the value. Somebody would have to come in and appraise it. But let's say it appraised for $1,650,000. That would be enough money to pay off our construction loan, pay off a decent amount of our capital accounts, and keep cash flowing the property. Now, what we were planning on doing was raising rents over the next few years and getting the property value up to somewhere between 2.2 and 2.5 million, which, since commercial properties are based on cap rates, is entirely doable. Then we would have been able to pull out additional cash, distribute that in addition to the capital accounts for the investors, and continue to cash flow the property. So obviously, because we got a 1031 exchange offer, it was kind of an offer that we couldn't refuse, and that is why I called it my failed BRRRR. But there you have it for diving into the BRRRR method, obviously coined by Brandon Turner over at BiggerPockets. I actually love the name, it's very catchy. Buy, rehab, rent, refinance, and repeat. Think about using that strategy next time you're looking at commercial real estate.